So as business owners, and I happen to be a business owner as well, what we're seeing is, boy, people are now, I'm having the option to sell my business in a much more real way than I ever did before. And I know that if I don't do it well, yeah, I can accomplish it. I can tell people at the cocktail party that I sold my business, but I know that the possibility of failure in some way, shape, or form is pretty material. And that failure can be the form of, again, material, didn't get enough money, or it can be in these qualitative aspects of, boy, I sold my company, but
Welcome to 7 to 8, our special series on 7 to 8 figure entrepreneurs. In this special series, I interview $1 million, some $10 million, and even some $1 million business owners who uncovered their twists and turns in their entrepreneurial adventure in order to help you to avoid the potholes and stick to the fast track. Welcome now to center stage, our next special guest. Hey there, peeps. This is Michelle Nedelec, and I'm super glad that you're here with us today because I am here with my most amazing guest, Trever. Trever, thank you so much for being here with us today.
excited to be here.
Awesome. So give everybody the highlight of who you are and what you do for business.
Sure. I'm Trever Acers. I'm one of the managing directors of Objective Capital Partners. We're a middle market investment banking firm, been around for about 15 years. So our investment banking group primarily focuses on sell side, so essentially representing owners in the sale of their businesses. Those are, call it 20 to 150, or 20 to $250 million in enterprise value in about 5 different industry segments.
Cool. So we will totally get into all of that. But before we do, I want to back up just a little bit. How did you get into investment banking as your thing?
Sure. I actually started my career in strategy consulting. Went from there to technology, from early stage tech companies into private equity. And in private equity, you're looking backwards, right? You're looking at companies that you're trying to purchase. And what I saw was a lot of mid-size and smaller businesses incredibly poorly represented. They weren't being helped in making really thoughtful decisions. And so that's where I saw this opportunity, and we came in and created what today is Objective. The goal was to help these entrepreneurs as they're thinking about, here I am today, where do I want to go? What are the outcomes that I'm trying to achieve? Help them make these exceptionally good decisions, especially in the context of selling that business.
Right. Well, and I know that there's a lot of entrepreneurs, there's a lot of entrepreneurs that want to grow their businesses. They want to scale and succeed. And as you know, people don't know what they don't know. And it's being able to harness your expertise, your experience, and your objectivity of, yeah, there's 28 things you could do here, but what's the one thing that's going to harness all of the resources that you already have to be able to make the most amount of difference? So when you're working with businesses, what does that process look like?
Yeah. Well, let me touch on the 2 things that I think are like compelling to make it important or interesting or to create the context. And the 2 of this is that as in the last 10 to 15 years, we've had this massive growth of private equity firms. These are professional, typically pension-funded buyers and builders of companies. What that's done then is massively increase the amount of unsolicited interest that business owners get on a daily basis. I want to buy your business. Oh, I love what you're doing. I want to buy your business. And you hear it from the most random people you've never heard of, or it's the partner you've been working with for 20 years, but they're getting this solicitation this unsolicited solicitation in an incredibly large volume. The other aspect of that is that the companies are getting purchased earlier. Because of all that interest and demand, people are looking to buy them earlier and earlier. So now as business owners, where 25 years ago, we might have said, hey, I don't even think about selling my company because I'm so many years off. I'm not in the rocking chair yet. I'm not ready to go. The opportunity is so much more liquid today, so much more real and out there and viable. So that's one factor that's happening. The other factor then is looks at the outcomes. And the outcomes say something like this. There's a bunch of surveys that if you look at them together, you recognize that about greater than 85% of business owners surveyed 2 years after their sale feel like they failed in at least one material way in their transaction. And if you look at the data and you ask them and you do your own surveys, you hear things like, I sold too early, I didn't get enough money, the earnout didn't work out. It's all these reasons. But the root cause of all these issues, they did not know what they wanted when they went into it. So as business owners, and I happen to be a business owner as well, what we're seeing is, boy, people are now, I'm having the option to sell my business in a much more real way than I ever did before. And I know that if I don't do it well, yeah, I can accomplish it. I can tell people at the cocktail party that I sold my business, but I know that the possibility of failure in some way, shape, or form is pretty material. And that failure can be the form of, again, material, didn't get enough money, or it can be in these qualitative aspects of, boy, I sold my company, but all my people got fired. All my customers did wrong. I just had a conversation yesterday with someone, and it's crushing, right? As people, right? When we're talking about fulfillment and we're filled in many different currencies, it's crushing to take that, sell that company, that thing that we built that's amazing, and not get that amazing outcome. So that's really what we're in the business for. And we call it a 2 a.m. number. My goal is 2 a.m. My client wakes up 2 a.m., 2 years after their deal. They look themselves in the mirror and all they say is, that was a good decision. Not fireworks, not, oh my God, that was the best thing. That was a really good decision. That is incredibly hard to achieve. And that's what we're in the business of.
I love it. So what makes a difference between somebody that's going to buy and look at kind of putting those assets into a pension fund versus somebody that's going to look at a business and take it on as maybe a division of their company or something that just builds equity in their own company?
Yeah, so we characterize that as a private equity purchase or a strategic acquisition. There's a little bit something in the gray, actually the most exciting, from my perspective, the most exciting buyers, which are companies that are already owned by a private equity firm coming to buy you. They call those add-on transactions. Those tend to be very good transactions because you've got a buyer who is not only getting all the strategic benefits that you would get in a strategic deal, but they also have the money and the mandate to do the deal. And it tends to be a really good buyer class. But the private equity historically is saying, hey, look, I want to buy this company. I want to give you resources, guidance, help, and I want you to build it. Strategics are often saying, I want to absorb you, right? It's the Microsofts calling us and saying, hey, we're so impressed with what you've done. We need you to be part of us. And there's pros and cons of each. The mix in terms of number of transactions in the United States depends on what data source you look at. It tends to be around 50-50. I would tell you that private equity transactions, I think, are outpacing strategic. They certainly have just the growth in number of private equity firms in the United States is certainly pushing that. But that's who we're often getting calls from as business owners. And even worse, we're getting a lot of calls right now from advisors who are supposedly representing buyers. Boy, I'm representing a company. They want to buy a company in your space. Oh, okay, maybe. So, but the concern is, how do I deal with all of this? I got all this interest and I've got a business to run that's keeping me up all day, all night anyways. And so this is where we advise a lot of clients around, if we're not at the point where we're ready to sell today, but we're getting all this interest, we need to have a plan. We need to have a plan to aggressively disqualify all this interest so I can focus on building my company. And one of the ways we characterize that is going back of the cost of failure. Boy, if you go through a sales process, and here's the scenario, Microsoft calls you and says, hey, we love your company. We want to buy, we love what you're doing, we want to buy you. The cost of that conversation kind of going along, meandering for 6, 7, 8 months, which is, this prototypical thing that kind of happens, the cost is massive. If it does not end up in a transaction, which statistically the probability is lower, what's likely going to happen then is you're going to, as an entrepreneur, take your eye off growth. And as we take your eye off growth, we can actually look at whatever the relevant metric, if it's revenue or earnings that you didn't get because you were so enveloped in this conversation that had you known what you wanted, may have never even started. And now the loss of that is, and I'll just give you an EBITDA example. If I'm trading for 10 times EBITDA and I have $500,000 less earnings, less EBITDA than I would have otherwise made had I been focused, you can look at that $5 million of enterprise value that I just destroyed because I didn't say no. I didn't turn that off. And so we're teaching clients how do we set a set of criteria early on that says this is what success looks like. How do I then qualify these buyers? Only talk to the ones that really make sense, and then aggressively disqualify them. And that scenario might be something like this. That's Microsoft. Love it. Love what you're saying. I am on a 3-year growth plan. Just to let you know, and we talk a little about the synergies and how it would be beautiful. And then I might say something like, but my shareholders are probably not going to sell for less than $50 million, just to let you know. So if that doesn't make sense based on my economics, which often don't justify that $50 million, let's partner. Let's find some other ways to create that relationship because you're such a great fit. And then we get there, we can revisit this conversation. And what that allows me to do is give them the takeaway sale. Hey, you can hit the buy now button and buy me for 50 million or more. We're creating a floor, not a ceiling with that strategy. But the other piece of it is I'm setting them up to potentially be an acquire X number of years behind. And then the other thing I'm doing is not taking any of the calls from the people that aren't those incredibly good fits, either the best fit 5 or 6 strategic buyers in your space or the private equity backed strategic who's a really great fit. I'll take those calls. Everybody else, I don't take those calls until I'm ready. Until I'm at that point where my economic metrics justify that goal, that price that I want to sell the company for.
Well, you've just created about 1,000 questions in my mind, but I'll let you talk.
Sorry. It's a fun process.
I may ask you about 28 of them. Pick whichever one suits your purpose better. So when somebody's looking at that and they're saying, okay, say they have a $5 million company and they see it potentially growing to a $50 million company in say 5 years, just for the sake of easy numbers. And the buyer is looking at this $5 million company going, hey, we could really use that. And if we used it, let's say it grows to 100 million. They see that potential and they see that there's things in there that they could change and play with. Are they more apt or less apt to be in that partnership and going, yeah, we'll help you build that because we agree, we see it growing to that. And if you're going to hang around and play, we can see that happening in 3 years if you play our way. Like, is that kind of the negotiation that happens?
Yeah. I'm in this exact scenario right now. Very, very common situation for us. We often work with clients 3 to 5 years before sale, giving them quarterly guidance on what's our valuation today, where are we going, what do we need to do to get there, and how do we deal with all these calls that we keep getting. It's a challenging scenario because what you're saying is that $50 million, my $5 million, but my financial metrics, which justify a $5 million valuation, clearly don't justify a 50. But if the overwhelming strategic value merits you still paying me $50 million, we can start that conversation. We can start that negotiation. We may end up higher than 50, but we can start that conversation. That's that ability to be very upfront. It's one of the errors that we see entrepreneurs very often do is not sharing revenue and earnings information early on with acquirers. And now you would often traditionally say, boy, I don't want to do that until I sign an NDA, and then it's this long drawn out process. But there's very rarely a ton of strategic rationale for why you wouldn't share that information. And what it does for a buyer is to say, oh, you're that size? Oh, okay. I can't buy something that size. I need to be, you can save yourself months of conversation or at least weeks of focus by saying, hey, here's my revenue. Here's my ballpark earnings. Let me just be upfront with that. And by the way, now I can say, by the way, 50 million is probably what our shareholders would be looking for. So it's a very common process. And we're trying to just be good partners with these buyers. They're often people we respect, that we like. Maybe we've worked with them for a long time. And then in that case, once we've said no and kind of figured out there's probably not a fit today, yeah, there's a lot of opportunity for partnership. You got to be careful. You want good partners. There are partners that'll say something, that'll be like, start realizing, boy, if we send you our business and we double your business size, I'm now paying for the business that I gave you. And that's true. And so we just got to be careful about exclusivity and other elements like that. But more commonly, you see good partners who are just interested in, wow, if it doesn't make sense for me to buy this capability, this technology, this service, I can partner with you for a while. And there's an added benefit to that. Not only does that help us grow our business, but it helps them as a buyer get more and more comfortable. And as much the finance people want to think that sales are all about spreadsheets, this is a massive human element. And when a management team gets more and more comfortable with you as the potential target to purchase, they've seen you perform for a while, they get a sense for who you are as a company, they get that level of confidence, they're going to pay more.
And are most of these companies, I'm assuming they're looking for that asset. They're looking for something that's running by themselves, and they're more than happy that the owner, founder kind of takes that capital and goes starts another company, does the thing they do. Or is there usually a kind of a time limitation? We want you to run this. And how does that usually work?
Yeah, and it really hits the key is you're kind of hitting on is to really understand when an acquirer comes, what are they solving? What are they really trying to get at? And we could talk about a little bit about that in a second, but to your point, it's the common assumption, the starting place assumption usually is they want to hear that entrepreneur wants to keep working for a while. They're concerned about the transfer of customers, the transfer of other employees, the transfer of intellectual property or knowledge or know-how or leadership. They want to know that there's somebody there for some transitional period of time. Typically 2 to 3 years is that period of time that the acquirer wants to hear to make them comfortable. There are certainly exceptions to that when people say, hey, I don't even go to the office. I don't even know where it is anymore. I'm not important. There are certainly those situations, but the majority of the time they want to hear that they're going to stay. The flip side stat to that is I've not seen any surveys on this, but my experience is an entrepreneur is more likely to leave within the first 2 years. There may be some economic, goals or milestones they have to achieve to get their money, but most entrepreneurs end up transitioning right around that before or after that 2-year mark. It's hard as an entrepreneur to be part of a company. Imagine I'm directing everything and then suddenly I'm a cog in a public company. It's very common to see there be
we do notoriously make bad employees, and we know.
Yeah, and that's where I think business owners can be really honest with the buyer and saying, hey, just FYI, being part of a cog probably doesn't interest me, but being part of your innovation group, that interests me. Doing this new thing, leading an innovation after I transition my company, that interests me. As the buyer sees more and more value in that acquisition, that's a very positive thing in supporting a premium value.
Well, and two, I would think that entrepreneurs tend to have the attention span of gnats, that it's that curiosity and the vision and like you said, the innovation side of things, but also being able to kind of have the liberty to do something weird and different, which tends to go against kind of the grain of a corporation because they're going, no, this works and this is why we're doing it. Yeah. So when that, I guess could be a level of friction, but it's also that level of familiarity coming in. Are there kind of places and ways of making that, I guess, transition easier? Yes.
Yeah. Well, I mean, part of it is understanding. You talked about really understanding what you want before you get started. This is a piece of it. Yeah. What do I want my post-sale experience to be? And talk to entrepreneurs, and there's a huge range so there's no right or wrong. It's really about what fulfills that person. What does that look like? And then we integrate that into that strategy. So if one of the entrepreneurs, if we're working with a couple owners and one of them wants to go away, we want to make sure that we're engineering that into the story. This person is not critical to day-to-day operations. We wouldn't be here without them, but they're not critical to operations, which makes the buyer a lot less concerned about them staying. And then we want to, if there's somebody that's wants to stay, wants to take over that innovation division, we want to tell that story. Hey, you're going to love working with this individual. They really want to do this. They see a huge opportunity to drive this in your company, and there's value there. We do often want to diminish, if we can, or at least be very transparent about the fact that the business does not rely on that owner in a way that if that owner went away, the business would collapse. In those situations, and sometimes they just exist. But in a perfect world, we'd love that not to occur because we don't want the buyer to say, hey, I'm going to give you X% in cash, and by the way, the rest, I'm only going to pay if you stay over 2 years, or if you achieve this other element. And what they're seeing is risk, and they're asking that seller to help them bridge that gap. Most sellers don't want that. They want as much cash as they can get or stock.
Well, and I guess the root of my question is, I guess is there two different personality types? One that goes, hey, I just want to buy out and I'm going to start this completely different thing like rabbits over here. And you're like it's got nothing to do with what's going on. And then somebody else going, oh, I get to head innovation. And so I get all your resources and I get to fast forward all of my decisions.
Yeah, there's a huge range of those, right? There are folks that say, if I give up control, this is what you often hear. The day I give up control, I want to be out. Well, why? Because I'm an entrepreneur and I really like to control. And that's great. That's a wonderful thing. We just really want to be clear and transparent so we have a great situation with the buyer. Mm-hmm. The alternative being, I really want to stay. There's something I want to do. Within that spectrum, it's actually not linear. There's a lot of different elements, and some of them can be like, so how important is keeping your team together? How important is your brand? How important is the technology that you're transitioning, the fact that gets amplified in your industry? And as you talk to entrepreneurs, you'll hear a range of outcomes. Some people really just want the check, and others say, the check's great, but if my technology gets buried and doesn't get amplified, I'm going to be hurt. That's not okay. And so now we know what buyers to solve for. Now we can aggressively disqualify buyers who, even if they may come up with a great purchase price, if they're going to kill that technology or destroy the team or get rid of the brand or whatever that is that really matters to us, we can aggressively disqualify them and solve for the folks that are going to achieve those best achieve our objectives.
Well, and you have clearly articulated a lot of the issues that entrepreneurs are going to face if they look at being acquired alone. So the whole mergers and acquisitions, great fun when you do it right, but when you do it wrong, it's a disaster. So yeah. In a minute, I'm going to ask you about a Cinderella story of one of your clients, but we're going to take a quick break first.
Are you running a business over 7 figures but still struggling with technology headaches? Pay attention, you do not want to miss this offer. This podcast episode is brought to you by Awareness Strategies, who is offering a custom-built digital adoption roadmap for anyone running a business over 7 figures who's wanting to grow their business in the next 5 years. And it's not just a roadmap, they offer full implementation as well if that scares the out of you. Check out awarenessstrategies.com/roadmap for more details today. The link's in the show's notes. Don't regret not doing this. Do it now. That's awarenessstrategies.com/roadmap.
So I'm super excited to hear about a Cinderella story of one of your clients.
Yeah. It's amazing. We've been doing this for a long time, so you have a ton of stories, but I think one that may be really applicable to this group is an entrepreneur that I was just talking to yesterday, a couple of years after their sale. And this is the prototypical situation that I think characterizes the change that we've seen and the things that are applying to business owners on a daily basis now. This company was a couple $1 million, they're a software company, $2 million in ARR, recurring revenue. That's how they're valued in that space. And we had been working with them. We had been introduced to them, did some analysis on where are we today? What's our valuation? What's relevant to you in terms of sale price? What's a life-changing number? And that's what their goal was. And then where do we need to do? So we met quarterly for a couple of years. Where are we valued today? What do we need to be at? What do we need to change in the business? And how are some of these conversations going? Finally, one quarter, we get a call. We get a call from our largest strategic partner, and the partner says, I want to buy you, and I want to buy you today. And so we looked at it, we compared our valuation analysis, we gave them our metrics. Our metric at the time, the goal that we were achieving was that we were shooting for was probably about 4 times larger than what our economic value, some third party valuing us would say. So 4x is where we needed to get to. And we basically went through this process and stopped this conversation around, yes, they're looking at our financials. We basically said, look, our financials are not representative of the value that we're willing to sell at today. If you want to buy us, we're on this 3-year growth plan. You're gonna have to buy us for this much larger number, 4x of what our economic value was. And we sat with that buyer. We laid out all of the synergies, how we're going to transform their business, and we'd worked with them for a while, so they had a pretty good idea. We then proposed this number, told them that that was at least the number we're going to go for. We went and negotiated that and ended up surpassing that. And that was a, call it 20 plus X ARR sale. And it typically, what's neat about that is prototypically, you would have waited 5 more years of growth to be able to justify that number. 5 years of my client's time back in that salt mine. And instead, we cut that off. That wasn't necessary. We got that number that changed his life 4 years earlier by using a methodology of that we do. We call it post-acquisition economics. We're really helping the buyer understand the value they're going to do. And then we use this aggressive disqualification methodology to figure out, is this the right time with this buyer? It was a great home run. We integrated, they made the purchase, spectacular value, got 90+% in transaction value in cash. The other thing we did, we're talking about the entrepreneur's role. We got a plan set at that time for, this is what the entrepreneur is going to do. They're going to transition this business, and this is the new head of innovation, interestingly enough, role that they're going to play at this public company. Incredibly compelling. So to me, that it's nothing that there shouldn't be any fireworks there. Yes, it was a good outcome, but it's the common strategy that we're using in these types of companies. And the key there is exceptional outcomes are great. Consistency of exceptional outcomes is what's required.
Nice. I love it when it's just kind of a normal daily occurrence to do something that's exceptional. It's not so normal in the rest of the business. You said something that was interesting to me in that the numbers didn't show what they were capable of doing. And a lot of businesses go, well, the numbers are the numbers and the numbers don't lie. But the numbers aren't always the whole picture. Talk to me about how you can look at somebody's business and their, whether it's their P&Ls or otherwise, and go, yeah, but there's more to this than that.
Yeah. So there's two aspects of that. One is the growth, right? So I'm at 5 million of revenue today and 1 million of earnings. That 1 million of earnings doesn't represent the fact that I'm going to be at 50 million of revenue in 4 years with a $5 million of EBITDA. So if you're going to buy me today, you can kind of do a discounted value and say, my $1 million, it's not representative of the opportunity, the value I have. So that's one, that growth scenario. The second scenario is this question of, what do I represent to buyers? So let's pretend that I am at 5 million of revenue and 1 million of earnings. But if this buyer acquires me, anyone in the industry that kind of does if they bought me, I can create $10 million of earnings for them within 24 months if they applied my technology. So now you look at it and you go, well, what's the value? Yeah, I'm 1 million of earnings, but I have the potential to create 10. And the scenario that I think that kind of illustrates this is, what is a glass of water worth when you're walking in the desert? Well, a glass of water is the cost of very low, right? It's a penny. But if you're in the desert and you're really, really thirsty, i.e. that glass of water has a massive impact, very different price. So there's two factors that really determine that.
Absolutely. And talk to anybody that's actually across the desert and they're drinking out of a goat skin. It's probably worth a lot.
Right.
Absolutely. Awesome. So when a business they're successful, they're looking at potentially selling, what kind of things should they be looking at in order to kind of increase profitability right away, or increase that the desirability for the buyer?
Yeah, so there's it's interesting when we ask this question around, people say, well, how do you maximize the value of a deal? Certainly, growing my revenue and earnings is good. You're thinking about the different types, the flavors of revenue. Certain types of revenue is more attractive to certain buyers than other types of revenue, i.e. reoccurring revenue tends to be more valuable than one-time project-based revenue. But what's really interesting is the dynamic where we see companies talking to a potential buyer. And the question is, now I'm in this conversation with Microsoft or ABC company. They're interested in buying me. How do I increase my value? What do I do? And it's odd to see that the typical ask from the buyer is, send me your financials. So it's a linear critique of my financials. You're going to beat me up all about my historical financials. And that's really not going to lead us to a place that I have the opportunity to increase value. the number one thing we know that we can increase, the way we can increase value is often just overlooked. And it's this, it's the help the buyer understand how much money they're going to make in the next 3 to 5 years by owning you. This is what we call post-acquisition economics. This idea that, yes, you're getting my revenue and you're getting my earnings, but if you sell your stuff to my customers and I sell my stuff to your customers, let's look at the incremental profit that we can create. And then from there, what's the incremental revenue? So often what's interesting is that people understand this and they talk about it at what we call the PowerPoint level, right? Oh, conceptually, that's interesting. And that's great. And that conceptually helps me as a buyer get interested. But if I want to get pushed to pay a premium, what I need to be able to do is not only characterize those, but quantify those and verify. Those are the two pieces that are left. So what we do is different than many other investment banks is when we're in this process of engaging with high fit buyers. So we've disqualified most of them. We got the highest fit ones. We lean in and we say to them, let's spend a little bit of time helping you understand how much money you're going to make. So we take those conceptual ideas and we start quantifying literally in spreadsheets. What's the gross profit? How many customers? What are you going to sell at this at? What's that revenue look like? What's the gross profit? What's the incremental profit contribution look like? And you do that for each of those synergies. How am I going to impact their company? And you can start looking at, wow, look at all this revenue and earnings that I'm going to create. And then we look at it through their lens. Boy, they're a public company. They're selling time for 20 times earnings. What does that mean? Well, that means that every $1 million of EBITDA that I create, I am creating $20 million of shareholder value for them. So as we look at it through their lens, now I can help them logically justify why they can pay a premium, why they can pay beyond the market range for me as a company. Having some competitive pressure or perceived competitive pressure helps that as well. But that is so different than often what we see is the mistake of going right to bone-on-bone negotiation. You offer me $20 million for the company and I want 30. Oh, okay, well, it's a really hard conversation versus you want to offer me $20 million. I'm showing you why I can make $200 million of enterprise value in the next 18 months. And your senior managers have justified and verified that the assumptions they need you get there are very achievable. So it comes back to this human element. You and I will pay more for an 8 in 10 chance of winning a $100 bill than we will a 2 in 10 chance. And that is the piece that we forget. We often do it in due diligence after the price is set, after the LOI. But why would we not, if we're good partners, have that conversation up front? And we're going to find one of three things. There's a spectacular fit that justifies a premium. There's an okay fit, or you know what? All these assumptions that we thought aren't going to come together. And we just saved ourselves months of due diligence that would have ended in no sale. So it's a process that we unfortunately do not see enough in our industry as something it's relatively unique that we do as a team, but it is the number one way to increase value in a negotiation.
Well, and it's pretty plain to see that that is exactly why somebody would want to connect with you. Now, before I get into that, does this work best with SaaS companies, or can it potentially work with other types as well?
We work with it across industries. So we have 6 industry practices. Our groups tend to be very focused in their spaces, but this methodology applies across the board. It doesn't really matter what industry you're in. We just see it apply all the time.
I love it. Well, I know our listeners are going to want more from you. So how do they start that journey with you?
Sure. You can go to our website, objectiveibv.com. Mm-hmm. They can look me up, Trever Acers at Objective. I'll introduce you to the right team within that group. We have a bunch of content in that website. We also have a bunch of stuff on YouTube as well. And we'd love to have a conversation. I think that's the key, is really not being scared of reaching out to advisors. They're not going to bite. They don't expect you to sign up tomorrow, but the guidance as business owners we can get by talking to the right advisors, giving them a sense for what should I be thinking about, right? What do I not know that I should be aware of? That is gold. If they end up in being clients, that's wonderful as well. But I'd encourage you to reach out to me and other advisors, be it your legal, your CPAs, maybe a little bit earlier than you might be thinking.
Nice. I love it. Well, and it's kind of like whetting the appetite when you walk into a restaurant you've never been in before. You want to smell the smells and see the foods and do the things, just if this is a totally foreign concept, just, get in, get a feel for it, and just start to whet your appetite for what it might look like.
Because that M&A attorney might say something to you like, by the way, you might want to think about this if you're thinking about selling in the next 3 years that you wouldn't have done. Or they may say to the SaaS company, by the way, you may want to think about wrapping some of these maintenance services that you do into your reoccurring revenue, because you're going to get 6x on that versus 1x on dollars of revenue of maintenance. I mean, these are the things that you can just have that quick conversation with the entrepreneur and significantly impact their outcome.
That right there. That's why you want to get a hold of Trever. So we will, of course, have all of Trever's links in the show notes. Go ahead and click on those. Open up in a new browser because we're not done yet. So Trever, I get to ask you, at what point in life did you know you're a special kind of crazy enough to think that you could become an entrepreneur?
I would love to say I was always an entrepreneur, but I don't think that's true. I think I've always thought different, and I don't think that necessarily gets rewarded in school. I had great experiences in school. Thank you, UCLA. I had great experiences in school, but I tended to always look at things a little bit differently. And I think that helps as an entrepreneur to be able to look at other people who are buying your services or product or what have you and tell them, hey, I know what everybody else is telling you. I know what's out there. But here's what's different. Here's what we do in our unique view and why we think it's a great fit for you. So I tell you, we've started the company, 15 years ago. I guess it was about then that we realized that our view of the world was just a little bit different.
I love it. You've been absolutely awesome. Any last words for our peeps?
No, I tell you, I just ask business owners to have a plan. Be really purposeful. The more purposeful that we are as business owners, the more likely we're going to get the outcomes we are. Be aggressive at reaching out to advisors. They're there to help you. They want your calls. They're rarely going to feel used, and they'll tell you if they do. I tell you that investment bankers, in particularly, there's a myth that our value proposition is to create market processes and introduce you to buyers. Everyone has Google and LinkedIn. That's not the value proposition. The value proposition of advisors is to get you more money and to help you make really good choices. That's what we'd love to do.
Thank you, Trever, for your time. I appreciate it immensely, and I know how valuable it is.
Yeah, a ton of fun.
Awesome. Peeps, this is Michelle Nedelec. Thank you for being here with us today. Be sure to subscribe to the show and share it with your friends. We love helping entrepreneurs grow. Thank you for listening to 7 to 8. If you're interested in upping your speaking game, be sure to connect with our guests with the links in the show notes, and connect with me to see how we can help you get your tech done for you and help your speaking dreams come true.